The road to retirement has gotten longer for many folks since the recession. As of March, 57% of U.S. workers had less than $25,000 in savings and investments, according to a report by the Employee Benefit Research Institute. The report also found that 28% of Americans have no confidence they will have enough to retire comfortably, the highest level in the study's 23-year history. If you fall into this camp, you're in luck. My next guest has 5 steps to getting your retirement back on track. Joining me now is Seth Stewart, president of Plan My Benefit, which offers Social Security education and retirement planning to individuals and advisors. Seth, welcome to the program.
Hey, thanks for having me.
Let's go ahead and jump right into your tips. First up, you say contribute to your 401k as much as an employer will match, but the amount you decide to contribute over that match may not be such a good idea in certain instances.
Well, obviously, you want to get as much of the employer's contributions as you possibly can. Anything over and above that, we typically suggest going into a traditional IRA. One of the reasons being is you have many more options outside of the 401k plan. Most 401ks may give you 15 to 20 different investment choices. Now, outside of the 401k, you have the same 15 or 20, but now you have thousands more. Now, obviously, that could vary depending on someone's income, because contribution limits in 401ks, as we know, are much higher than in traditional IRAs.
Well, that sets up perfectly for your next step, which is that if you can, use a Roth IRA or a Roth 401k, right? Because unless you need those tax deductions up front, tax rates are probably only going higher in the future.
Yeah, I think we'd all agree there. You know, Roth IRAs, Roth 401ks, probably the most underutilized tool when it comes to retirement planning today. And like you mentioned, with the high probability that we're going to be paying higher taxes in the future, more often you may be better off to pay taxes on the seed. You know, consider yourself a farmer. You have the option to pay taxes on the seed, or you have the option to pay taxes on the harvest. Well, I'd rather pay taxes on the seed than my harvest, and retirement is absolutely tax-free. So huge opportunities in Roth IRAs.
Now, Seth, does this apply for the 22-year-old as much as the 52-year-old, if you will?
You know, I think it applies even more so to the younger generation with Roth IRAs. You know, and many people, because of their income, may not be eligible to contribute. Now, there's different rules with contribution limits and conversions. Totally different rules apply, but to your point, the younger generation is really in a much better position to take advantage of Roth IRAs today.
All right, next you say follow the 120 rule, which I'll ask you to define, and diversify.
Yeah, if you take 120, say we're dealing with a 60-year-old individual, you know, you deduct 60 from 120, approximately 60% of their assets should be in a safety a conservative environment. You know, even today, I may go as far as saying safety of principle, since the market's nearing all-time highs, or we're still breaking records periodically. But, you know, it's a different game. You and I were talking before we came on air. A lot of the rules that we thought would hold true when it comes to stock-bond relationships, those rules have kind of been pitched out of the window. So that's been game-changing moving forward.
Yeah, I mean, to your point in our discussion off camera, I mean, how has saving for retirement, really maximizing your savings via investing, changed since the financial crisis? Because the markets have changed so much. You try to diversify, and you've got asset classes, stocks, bonds, commodities, they're all moving in tandem in one direction, right? And you've had to be a much more agile investor.
Yeah, one of the only places to hide through the downturns has been cash. And, you know, if you sit in cash too long, you're losing purchasing power. You know, your buying power is slowly being eroded. So,
and rates are so close to zero, too.
Yeah, exactly. Yeah, with interest rates at historic lows, it's a tough situation right now. It's kind of the perfect storm. But as Americans, we really need to start doing a better job saving. Some of the statistics that you gave at the open are very alarming. Especially given the fact that we are living longer as a society. I mean, longevity, life expectancy has been extended. So retirements now are 30, 40, even 50 years long. And then you have all the pressure on entitlement programs such as Social Security. So we really need to do a much better job as Americans saving for retirement.
And what about using target date mutual funds, right? Those invest in a blend of stocks and bonds that are tied to a future retirement date. Is that really a good bet for the novice investor?
You know, it's an easy way to invest. I have a little caution when it comes to target date funds. A lot of 401ks have picked up target date funds because it really takes a lot of the fiduciary responsibility off of the plan administrators. in giving investment advice in the 401k, because when they ask the question, the administrators can simply ask, well, when are you going to retire? Well, here's a target date fund that may fit your needs. Typically, the internal expenses, though, on retirement date funds, target date funds, can be considerably higher than just a simple growth and income diversified mutual fund.
All right, and next up, you say consultant advisor, and to kind of move things along since we're running a little short on time, if you're nearing retirement, how do you decide when to take Social Security benefits and how to maximize that payout? What are some basic rules of thumb?
Yeah, first and foremost, you need to identify your optimal Social Security strategy. And at Plan My Benefit, we have a nationwide network of counselors that assists Americans in doing just that. But more importantly, once you identify that optimal strategy, it's about coordinating all of your other assets like your 401k, your IRA, and your savings around that optimal election.
All right, Seth, thanks so much for those helpful tips. So appreciate it.
Thank you for having me.
Seth Stewart, president of Plan My Benefit.